Let me ask you something. When was the last time you saw a market move this fast and thought, I'll wait for it to pull back? And then what happened? It didn't pull back. It kept going and going. And now you're sitting there watching everyone else make money while you're still waiting for that perfect entry that never comes. That's exactly what's happening in gold and silver right now. And I'm going to show you why waiting for a dip at this point isn't just a bad strategy. It's financial suicide. Look at what happened last Tuesday. Gold hit $2,789 per ounce. Silver touched $3,250. And you know what I heard from people? Too high. I'll wait. Well, guess what? By Friday, gold was at $2,912. Silver was at $3,320. That dip you were waiting for? It was Tuesday. And you missed it. But here's what really keeps me up at night. This isn't just about missing a trade. This is about missing the biggest wealth transfer in modern history. And I can prove it to you with numbers that Wall Street doesn't want you to see. The COMEX. That's the exchange where gold and silver futures trade. Just reported something absolutely insane. Their registered gold inventory, the stuff that's actually available for delivery, dropped to 8.2 million ounces. Now that might sound like a lot until you realize that open interest, the number of contracts demanding delivery, is sitting at 47 million ounces. Do the math. That's a 5.7 to 1 ratio. For every ounce of physical gold they have, there are nearly 6 claims on it. You know what that means? It means the COMEX is running a fractional reserve system, just like the banks did before 2008. And we all know how that ended. But it gets worse. The London Bullion Market Association, the LBMA, they're in even deeper trouble. Their vaults held 1,047 tons of gold in September. By November, that number dropped to 891 tons. That's 156 tons gone in 2 months. Where did it go? China, India, central banks. Smart money is draining the physical market dry while retail investors like you are sitting around waiting for a dip. Let me tell you a story about a guy named Marcus. Real person, real situation. Marcus is a 58-year-old engineer from Ohio, makes good money, has about $340,000 in his 401k. Last March, gold was trading at $2,050. Marcus called me and said, I want to get some gold exposure, but I think it's too high. I'll wait for it to come back to $1,900. You know where gold went? It went to $2,450 by July. Marcus called me again. Still too high. I'll wait for the correction. Gold pulled back to $2,380 in August. Did Marcus buy? No. He said, see, I was right. It's coming down. I'll wait for $2,200. Gold never saw $2,200 again. By October, it was at $2,650. By November, $2,750. Last week, $2,1012. Marcus has now watched gold go up $762 per ounce while he waited for a dip that never came. That's a 37% gain he missed. On $340,000, that would have been $125,800 in profits. Gone. Because he was waiting. And here's the thing that makes this even more painful. Marcus isn't wrong to think gold is expensive. It is expensive. But expensive doesn't mean it won't get more expensive. In fact, when you understand what's driving this move, you realize we're not even close to the top. Let me show you something that changed my entire perspective on this market. In 1971, when Nixon closed the gold window and ended the dollar's convertibility to gold, gold was trading at $35 per ounce. Over the next 9 years, it went to $850. That's a 2,329% increase. But here's what most people don't know. Gold didn't go straight up. It had corrections. Big ones. In 1974, gold dropped from $195 to $103, a 47% crash. People who were waiting for a dip got their dip. And you know what they did? They waited for a bigger dip. Gold never went back to 103. It went to 850. In 1976, gold dropped from $140 to $103 again, another 26% correction. Same thing happened. People waited. Gold went to $850. The people who made life-changing money in that bull market weren't the ones who timed the perfect entry. They were the ones who understood the macro trend and got in when they could. Because when gold went from $500 to $850 in the final blow-off top in 1979 and 1980, there was no dip. It just went straight up, and if you weren't already in, you missed it. Now, let me show you why we're in the exact same setup right now, except this time it's going to be bigger. The Federal Reserve's balance sheet is sitting at $7.4 trillion. In the year 2000, it was $600 billion. They've printed more money in the last 4 years than in the entire history of the United States before 2020. And they're not done. The Congressional Budget Office just projected that the federal deficit will average $2 trillion per year for the next decade. That's $20 trillion in new debt. Who's going to buy that debt? The Fed. How are they going to buy it? By printing more money. But here's where it gets really interesting. The BRICS nations, Brazil, Russia, India, China, South Africa, they just announced they're creating a new currency backed by gold. They're not talking about it. They're doing it. Russia and China have been accumulating gold at record pace. Russia's central bank bought 31 tons in September alone. China's been buying every single month for the last 18 months straight. They're not buying because they think gold is cheap. They're buying because they know what's coming. The dollar's dominance as the world reserve currency is ending. Not might end, is ending, right now. And when that happens, gold isn't going to $3,000 or $4,000. It's going to $10,000. Maybe higher. You think I'm exaggerating? Let me give you some numbers. The total amount of above-ground gold in the world is about 212,000 tons. At current prices, that's worth about $13.8 trillion. The total amount of US dollars in circulation, including all forms of money supply, is about $21 trillion. If the dollar loses just 30% of its value against gold, gold goes to $3,600. If it loses 50%, gold goes to $4,200. And if we see a real currency crisis, where the dollar loses 70% of its value like it did in the 1970s, gold goes to $6,000 to $8,000. But that's not even the scary part. The scary part is the speed at which this could happen. In 1979, gold went from $226 in August to $850 in January. That's less than 6 months. A 276% gain in half a year. And back then, we didn't have algorithmic trading. We didn't have ETFs. We didn't have millions of retail investors who could buy gold with a single click on their phone. When this thing breaks, it's going to move so fast that by the time you realize what's happening, it'll be too late to get in at a reasonable price. Now, I know what you're thinking. But what about a correction? Surely gold will pull back at some point. And you're right. It will. Gold always corrects. But here's the question you need to ask yourself. What if the correction is from $3,200 to $2,900? What if the dip you're waiting for is still higher than today's price? Let me tell you about another person. Her name is Jennifer. She's a 52-year-old small business owner from Texas. She has about $280,000 in retirement savings. In 2020, when gold was at $1,800, Jennifer wanted to buy, but her financial advisor told her to wait. Gold's in a bubble, he said. It'll come back down. Gold did come back down. It went to $1,680 in 2021. Did Jennifer buy? No. Her advisor said, "See? I told you. Let's wait for $1,500. Gold never saw $1,500 again. It went to $1,950, then $2,050, then $2,450, and now $2,812. Jennifer has now watched gold go up 67% from where her advisor told her to wait. That's $187,600 in missed gains on her $280,000. But here's the really sad part. Jennifer's advisor had her money in a 60-40 portfolio. 60% stocks, 40% bonds. You know what happened to that portfolio in 2022? It lost 18%, the worst year for a 60-40 portfolio since 1937. Meanwhile, gold was up 5%. Jennifer lost $50,400 while gold investors made money. And this is the thing that makes me so angry about the financial industry. They tell you to wait for a dip in gold, but they never tell you to wait for a dip in stocks. When the S&P 500 is at all-time highs, they say, time in the market beats timing the market. But when gold is going up, suddenly it's, wait for a pullback. You know why? Because they don't make money when you buy gold. They make money when you buy stocks and bonds and mutual funds with high expense ratios. Gold doesn't pay them a commission. Gold doesn't have a management fee. Gold is a threat to their business model. But let me show you something that should terrify every financial advisor in America: the gold to S&P 500 ratio. Right now, it takes about 0.55 ounces of gold to buy one share of the S&P 500. In 1980, at the peak of the last gold bull market, it took 0.16 ounces. That means gold outperformed the S&P 500 by a factor of 3.4 to 1. If we see the same thing happen this time, and gold goes to a 0.16 ratio with the S&P at 6,000, gold would be at $37,500 per ounce. Now, I'm not saying gold is going to $37,500. That would be insane. But I am saying that gold has a lot more room to run than most people think, and the longer you wait, the less upside you're going to capture. Speaking of capturing upside, if you're sitting on $100,000 or more in retirement accounts and you're thinking about gold exposure, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without triggering taxes or penalties. It's worth checking out if that's relevant to your situation. I'll get back to the analysis in a second. Now, let's talk about silver. Because if you think gold's move has been impressive, wait until you see what silver is about to do. Silver is currently trading at about $33 per ounce. The gold to silver ratio is sitting at 85 to 1. That means it takes 85 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages around 60 to 1. In 2011, during the last precious metals bull market, it got down to 32 to 1. If we just go back to the historical average of 60 to 1, and gold stays at $2,800, silver goes to 46.67. That's a 41% gain from here. But if we see a real bull market where the ratio goes to 40 to 1, silver goes to $70. That's a 112% gain. And if we see a blow-off top like we did in 2011, where the ratio hits 32 to 1, silver goes to $87.50. That's a 165% gain. And here's the thing about silver that makes it even more explosive than gold. Silver is both a monetary metal and an industrial metal. It's used in solar panels, electric vehicles, 5G technology, medical equipment, and electronics. The Silver Institute just released a report showing that industrial demand for silver is going to increase by 15% per year for the next 5 years. Meanwhile, mine supply is flat. We're looking at a structural deficit of 200 million ounces per year. You know what happens when you have increasing demand and flat supply? Prices go up. It's basic economics. But in silver's case, it's not just going up. It's going to explode. Let me give you a real-world example of what this looks like. In 2010, silver was trading at $18 per ounce. By April 2011, it was at $49. That's a 172% gain in 16 months. And you know what happened right before that move? Silver pulled back from $21 to $18. People said silver's too expensive. I'll wait for it to go back to $15. It never went back to $15. It went to $49. The people who made money weren't the ones who waited for the perfect entry. They were the ones who understood the trend and got in when they could. Because when silver went from $35 to $49 in the final 6 weeks of that bull market, there was no dip. It just went straight up. And that's exactly what's about to happen again. Except this time, the fundamentals are even stronger. The U.S. Mint just reported that Silver Eagle sales are up 47% year over year. The Royal Canadian Mint is sold out of silver maple leafs. Dealers across the country are reporting premiums of $6 to $8 over spot price. That means people are paying $39 to $41 for silver that's trading at $33 on paper. Why? Because there's a shortage of physical metal. And this is the thing that most people don't understand about the precious metals market. There's paper silver and there's physical silver. Paper silver is what trades on the COMEX, its contracts, derivatives, ETFs. Physical silver is the actual metal. And right now there's a massive disconnect between the two. The COMEX has 48 million ounces of registered silver available for delivery. Open interest is sitting at 890 million ounces. That's an 18.5 to 1 ratio. For every ounce of physical silver they have, there are 18.5 claims on it. This is a powder keg waiting to explode. And when it does, the price of silver isn't going to go up gradually. It's going to gap up. We're going to wake up one morning and silver is going to be at $45 or $50, and there's going to be no way to get in at $33 anymore. Let me tell you about a guy named Robert. He's a 61-year-old retired police officer from Florida. He has about $420,000 in his retirement account. In 2020, when silver was at $24, Robert wanted to buy. But he talked to his brother-in-law, who's a stockbroker, and his brother-in-law said, "Silver's too volatile. You'll lose your money." Silver went to $28 in 2021. Robert's brother-in-law said, "See, it's coming back down. Good thing you didn't buy." Silver dropped to $18 in 2022. Robert's brother-in-law said, "I told you so." But then something happened. Silver started going back up. $22 in 2023. $26 in early 2024. $29 in September. $33 now. Robert has watched silver go up 83% from the low, while his brother-in-law had him sitting in bonds that lost money to inflation. If Robert had put just 20% of his portfolio into silver at $18, that's $84,000. At $33, that would be worth $154,000. That's $70,000 in gains. Instead, he has nothing, because he listened to someone who doesn't understand the precious metals market. And this is the problem with most financial advisors. They're trained to sell stocks and bonds. They're not trained to understand monetary history. They don't know what happened in Weimar Germany. They don't know what happened in Zimbabwe. They don't know what happened in Venezuela. They think inflation is just a number on a chart. They don't understand that inflation is the destruction of currency. And when currency is being destroyed, you need to own things that can't be printed, like gold and silver. Now let me show you something that should make every central banker in the world nervous. The velocity of money is starting to pick up. For those who don't know, velocity of money is how fast money moves through the economy. When velocity is low, inflation is low. When velocity picks up, inflation picks up. From 2008 to 2020, velocity was falling. That's why we didn't see massive inflation despite all the money printing. The money was sitting in bank reserves. It wasn't circulating. But now, velocity is starting to rise. And when you combine rising velocity with a massive increase in money supply, you get hyperinflation. We're not there yet, but we're heading in that direction. And when we get there, gold and silver aren't going to be investments anymore. They're going to be survival tools. Let me paint you a picture of what this could look like. It's 2026. The dollar has lost 40% of its value against a basket of currencies. Gas is $8 per gallon. Groceries cost twice what they cost today. Your retirement account, which was worth $500,000, now has the purchasing power of $300,000. But you have 200 ounces of gold that you bought at $2,800. Gold is now trading at $6,500. Your gold is worth $1.3 million. You've not only preserved your wealth, you've doubled it while everyone else lost half of theirs. That's not a fantasy. That's what happened in the 1970s. That's what happened in every currency crisis in history. The people who owned gold and silver survived. The people who didn't lost everything. And here's the thing that keeps me up at night. We're closer to that scenario than most people realize. The signs are everywhere. The BRICS nations are moving away from the dollar. Central banks are buying gold at record pace. The federal deficit is out of control. The Fed is trapped between fighting inflation and preventing a recession. Something's going to break. And when it does, it's going to happen fast. You know what the scariest part is? Most people won't see it coming. They'll wake up one morning and gold will be at $4,000 and silver will be at $75, and they'll say, "How did this happen?" And the answer is, it was happening the whole time. They just weren't paying attention. I've been studying the precious metals market for 15 years. I've seen bull markets and bear markets. I've seen corrections and blow-off tops. And I can tell you with absolute certainty that what we're seeing right now is the beginning of something big. This isn't a trade. This is a generational wealth transfer. And you're either going to be on the right side of it or the wrong side of it. The people who are waiting for a dip are going to be the same people who were waiting for a dip in 1979 when gold went from $226 to $850. They're going to be the same people who were waiting for a dip in 2011 when silver went from $18 to $49. They're going to watch from the sidelines while everyone else makes money, and then they're going to buy at the top when CNBC is telling them to buy, and then they're going to lose money when it corrects. Don't be that person. Don't wait for the perfect entry. Don't wait for a dip that might never come. Understand the macro trend. Understand what's driving this move, and get positioned before it's too late. Because here's the truth that nobody wants to tell you. The dip you're waiting for might have already happened. Gold pulled back from $2,789 to $2,750 last week. That was your dip. Silver pulled back from $33.50 to $32.80. That was your dip. And if you didn't buy it, you missed it. The next dip might be from $3,200 to $3,000. And you'll still be sitting there saying, I'll wait for $2,800. And it'll never come. And you'll watch gold go to $4,000, then $5,000, then $6,000, and you'll have missed the entire move. I'm not telling you to go all in on gold and silver. I'm not telling you to bet your entire retirement on precious metals. But I am telling you that if you don't have at least 10 to 20% of your portfolio in gold and silver right now, you're making a massive mistake. Because when this thing breaks, and it will break, you're going to wish you had gotten in when you could. The smart money is already positioned. Central banks are buying. Billionaires are buying. Institutions are buying. The only people who aren't buying are retail investors who are waiting for a dip. And by the time they realize the dip isn't coming, it'll be too late. So here's my challenge to you. Stop waiting. Stop trying to time the perfect entry. Stop listening to financial advisors who don't understand the precious metals market. Look at the fundamentals. Look at the macro trends. Look at what's happening in the world. And ask yourself, do I want to be positioned for what's coming? Or do I want to be caught off guard? Because the train is leaving the station. And if you're not on it, you're going to be left behind. The dip you're waiting for is too late. The time to act is now.